Welcome back to our latest explainer. Today, we're cutting straight through all that internet noise and speculative frenzy to do a grounded, objective reality check on digital assets. We are looking directly at Herman Strange's incredibly timely book, Beyond the Hype: The Truth About Cryptocurrencies' Downsides and Dangers. If you've ever wanted to understand the actual risks and the fundamental roadblocks keeping crypto from taking over the financial world, this is the deep dive for you. Okay, let's dive into this. We aren't here to declare crypto dead or alive, but rather unpack 6 distinct roadblocks: volatility, lack of regulation, security risks, environmental impact, lack of acceptance, and complex technology. Let's hit that first hurdle. Starting with volatility. Unlike traditional assets that are backed by cash flows or physical properties, crypto is driven purely by supply, demand, and market sentiment. And because liquidity can be thin and the market is heavily dominated by highly emotional retail investors, we see these wild, totally unpredictable price swings in literally a matter of hours. And this brilliantly illustrates the real-world impact of that volatility: $550 billion. That is the staggering amount of value completely wiped out during the early 2018 market crash. The total market cap plummeted from $830 billion down to $280 billion in mere weeks, with Bitcoin alone dropping 95% from its peak. I mean, it's just a brutal financial whiplash. Right, which brings us to a lack of regulation, a true regulatory Wild West. Because cryptocurrencies are decentralized, tracking bad actors across international borders is incredibly difficult. Historically, this environment has been a massive breeding ground for fraud. We've seen multi-billion-dollar pyramid schemes like OneCoin, devastating Ponzi schemes like BitConnect, and black markets like the Silk Road. The absence of a clear, unified legal framework leaves investors incredibly vulnerable. And when your money is purely digital, cybercriminals definitely take notice. Hackers are continuously targeting exchanges and individual wallets using 3 devastating methods. You've got phishing to steal your credentials, malware designed to lift private keys directly, and DDoS attacks that can actually lock you out of your accounts right during critical market crashes. So, the crucial point is you have to be your own security guard. This means using a hardware wallet, keeping your private keys entirely offline, absolutely enforcing 2-factor authentication everywhere, and rigorously updating your software. In the crypto space, you are your own bank. If you find this analysis valuable, please like and subscribe to Knowledge Lighthouse to help us bring more truths to light. Okay, moving on. Let's see how this builds into our 4th reality check: the environmental impact. The numbers here are really vital to understand impartially. Bitcoin's proof-of-work mining process consumes about 110 terawatt-hours every single year. To put that into perspective, that's equivalent to the power draw of entire small countries like Argentina. Now, the traditional global financial system does use more, about 650 terawatt-hours, but it also serves a vastly larger global economy and processes exponentially more daily transactions. Taking that environmental impact down to a more granular level, look at this figure: 63 metric tons. That is the staggering amount of carbon emissions that can be generated just by mining a single Bitcoin, depending on the energy source used. It's a massive carbon footprint. However, the industry isn't just ignoring this. We are seeing a push toward potential solutions, like migrating networks to a much more energy-efficient proof-of-stake model, and mining operations actively seeking out renewable energy sources like hydro, solar, and wind. So why can't you just buy your groceries with crypto everywhere yet? Well, it comes down to these fundamental barriers. What's really interesting about this adoption hesitation is the math for merchants. Businesses absolutely fear the volatility. They do not want the value of their revenue dropping 10% before they can convert it to cash. Add in regulatory ambiguity, complex technical hurdles for integration, and a lack of physical payment infrastructure, and you can see why adoption is so slow. However, emerging innovations like stablecoins and decentralized finance, or DeFi, are actively trying to solve these exact merchant headaches. But even if businesses accept it, we have to talk about the everyday consumer. The complexity barrier is a massive roadblock. For the average person, the technology behind blockchain is unforgiving and highly intimidating. You have to navigate a sea of dense jargon, figure out how to securely manage cryptographic private keys, and accept that if you make a typo on a wallet address, your money is gone forever. There's no customer service hotline to call. This steep learning curve is definitely keeping a massive portion of the public on the sidelines. As we wrap up our analysis, we look to the future. While the 6 risks we've covered, volatility, regulation, security, environment, acceptance, and complexity, are highly substantial, the technology is moving incredibly fast. Ongoing innovations are targeting these exact weaknesses. Developers are rapidly building scalability solutions, like the Lightning Network, for faster, cheaper transactions. Governments are inching toward regulatory clarity, networks are becoming energy efficient, and user interfaces are steadily simplifying. The future depends entirely on conquering these specific hurdles. To truly grasp the nuances of this evolving financial landscape, there is immense value in sitting down with the physical text. For the complete deep dive, own the paperback. Get your high-quality paperback edition on Amazon via the link in the description. Add it to your collection today. Please share this video and check the description for more. Ultimately, we have to ask, will crypto evolve fast enough to fix these fatal flaws, or is it doomed to remain a speculative Wild West?